So welcome class again. This is question 6 and of CHRP Accounting and Finance, CHRP paper, Certified Human Resource Professionals. So explain 5 ways in which the net present value, 5 ways in which the net present value fulfills the requirements for a good investment evaluation. 5 ways in which the net present value fulfills the requirements for a good investment evaluation. Now, we have so many other tools that are used for in appraising investment. NPV is just one of them, but so far the most adopted one, the most embraced one, because of its advantages that it has, the advantages that it has. And perhaps that's why the question is asking, explain 5 ways in which NPV fulfills the requirements for good investment evaluation. What are the advantage, the benefits it has over the others that it fulfills the requirements for good investment evaluation. Now, these are appraisal techniques. We have NPV, we have IRR, internal rate of return, we have payback period, we have discounted payback period, we have this other one called ARR, accounting rate of return. We also have, there are quite a number. These are the most obvious ones. The discounted, it's called the profitability index method. So all these are the discounting, the investment appraisal techniques. But NPV is outstanding. So the question is asking 5 ways in which NPV fulfills the requirements for a good investment evaluation. So we'll go straight to the key points why NPV is outstanding, or why it fulfills the requirements for a good investment evaluation, why it's the best when it comes to investment appraisal or evaluation. So number one is that it considers the time value of money. That a shilling today is not worth a shilling tomorrow. Time value of money. It's actually one of the discounted methods. And when you are working it, you realize that the formula, you talk of, we use the discounting formula. I wish we could have a question on that, but possibly next time we'll have a question on it. But we work it through the discounting techniques. That means that it considers the time value of money. The other thing is that it also considers all the cash flows. There are some methods here among these that don't consider all the cash flow, like the payback period, discounted payback period. Once you recoup your investment, you stop there. But the NPV will consider all the cash flows, which gives it again an upper hand compared to the rest. The other thing about NPV is that it factors in the risks. It considers or factors in the risk. The formula for NPV, I think it's important we mention it. The formula for NPV is summation of because we are talking of discounting, just discounting it's basically the cash flows. Take the cash flows divided by 1 plus R raised to power n. Cash flow summation, and it should be the summation of the cash flows over 1 plus R raised to power n minus now the initial capital that you will have invested here. The initial capital, we talk of I naught, the initial capital. So that will be the formula of, I think that should be the formula of summation of the cash flows over 1. This is the discounting. Now the R here, this is R is what we are talking about here. This is the risk factor. And then N, of course, is the time. So add the risk factors, and that's what we are talking about here, that it considers or factors in the risk element in every investment, which is very important. There are some other tools here that don't factor in the risk element, especially like all these other non-discounted techniques. So that comes in as one of the key elements why NPV is outstanding. Then its decision criteria is also very straightforward. Decision criteria very straightforward. We say accept if NPV is positive, and then reject if NPV is negative. It's as simple as that. And you can see this is the whole sum, and then you less the initial investment. If you get a positive answer, you accept. If you get a negative answer, you reject. Unless if you're talking about 2 or more items, then in that case you pick the one with the highest positive. Now, and even the computation of NPV is quite user-friendly, unlike others. Look at this IRR. IRR, you will have to iterate so many times. It's a trial and error. You will have to go, then use other formulas. I know you must have used that formula for IRR. So it's quite not friendly, and most students will not like it because of it's a bit long and cumbersome. But this one, you go straight to the point, so it's user-friendly, and that makes it very easy for anybody to use. Then it accepts the conventional cash flow patterns. Accept the conventional cash flow patterns. It gets the cash flows as they are. So that comes in also as an advantage. Let me see if we have any other one. It's a good measure of profitability, considers risk, provides better forecast. I think let's work with this. We wanted 5, we can work with any of these. So that should be able to give you the 10 marks. Let's look at this part B of this question. Wema Transporters Limited purchased the following motor vehicles. So 1st January 2020, KD Wagon 600. 1st July 2021, KF Toyota 1.8. The firm depreciates its motor vehicle at 20% per annum on cost. For each of the years ended at 1st, and prepare a motor vehicles account. For each of the years ended 31st December 2020 and 2021. Sorry. So, there we go. Purchase the motor vehicles. Now, motor vehicle is an asset. So, the year 2020 will be pretty straightforward. We simply come here and say motor vehicle account. Motor vehicle account. This is quite straightforward. So, we say 1st January 2020. Say the bank we purchased. So, we say maybe the bank, money came from the bank, 600,000. That is the motor vehicle account. So 2020, this is how it will look like. The firm depreciates its motor vehicle at that. For each of the years ended at 1st December 2020 and 2021, prepare a motor vehicle account. So 2020 motor vehicle account, this is how it will look like. We are done. 600,000. Talk of starting a question and finishing it there and then. So we'll come here and say 31st December 2020, balance carried down 600,000, and then 1/1/2021, balance brought down 600,000. So we are done. This is now the 2022 motor vehicle account. So we can come here and prepare the 2021 motor vehicle account. So motor vehicle account for 2021, credit, debit. So we'll say the balance, this one, we started with, remember we closed with this. So we'll simply come here and say 1/2/21, balance brought forward. How much? 600,000. And then this year, in 1st July 2021, we bought another KF Toyota. So we'll say bank, money came from the bank, 1.8. And then we close the year. So this will be 2.4. Close the year. We'll not have any other transaction again. So 2.4. So this will be, we come here, we say 31st December 2021, balance carried down 2.4, like that. That is it. And then we say 1st January 2022. That is the following year now. We'll have balance brought down. I hope you are seeing how I'm using the brought forward, carried down, and brought down. So this will be 2.4. So when we come next year, we'll start with 2.4 as the value of our assets. So these are motor vehicle accounts. We are done with this. Motor vehicle account for 31st December 2020 and 2021 respectively. So the next question is provision for depreciation of motor vehicle account. Provision for depreciation of motor vehicle account. So I'll come here and prepare it. Provision for depreciation account. So credit, debit, just like we had it. Now this is it's a reduction in asset. When we reduce asset, we credit. This is the asset, 600,000, but now what has been used up, we will credit it. So we'll come here and say, in January, provision for depreciation of motor vehicle account. The firm depreciates its motor vehicle at 20% per annum on cost. 20% per annum on cost. So the first year, because it will depreciate by 20%, so it will be 20% of 600,000. 600,000 is the cost of the motor vehicle. So this gives us 12 and the 4 zeros, 120,000. Yes, it's 120,000. 20% of 600,000 is 120,000. So we simply come here and say, this is now depreciation. We'll say, we'll charge it to the, which account is this? Motor vehicle account. I think it will come from the motor vehicle account. So we talk of 31st December 2020, because that's when we charge the depreciation at the end of the year. So we say motor vehicle account, how much? 120,000. 120,000. So it's to show that we are actually, it's this figure here, 600,000, and then it depreciated by 120,000. So the value of this, the real value of this vehicle, the first vehicle in 2020, was 480,000. So you can see 600 is on the debit, 120 is on the credit. It gives us the net figure of 480,000. So we close this 120,000, 120,000. And then we come here, we say 31st, 12/20, balance carried down is 120,000. Now this is for 2020. Now you might want to prepare, you see what we've done in 2021, we prepared different accounts because the question wanted for each of the years ended at 1st December 2020 and 2021, prepare this. But you can as well run this going downwards. So instead of opening another account here for 2021, like we've done here we've opened 2020, 2021. You can as well just proceed and say 1, 2, because this is the balance carried down. 1, 2, 1, 1, sorry, 2021, we'll say balance brought down of 120,000. You see? And then now we calculate the depreciation for this year. Depreciation, motor vehicle account. Depreciation for this year. Now, the second year. So, we'll come here and prepare. You see now we're already working on the 2021 accounts. We've not opened another ledger. It's possible. Even for the motor vehicle, you can choose to have this beneath this. It's okay. It will still show 2020 and 2021. But we chose to have it differently. This one, I'll choose to put it together, just so that you can have the two different ways with you. So let's work out the depreciation for 2021. In 2021, remember, the farm depreciates its motor vehicle 20% per annum on cost. So in 2021, it also means that this first vehicle of KD wagon will depreciate by again 120,000. It will depreciate by 120,000 because the farm depreciates its motor vehicle at 20% per annum on cost. Then this other vehicle was bought in 1st July 2021. So it only served for 6 months. KF Toyota. So we might want to apportion that and get the, first of all, let's get the 20% of its value. 20% of 1.8. That should be 360,000. 20% of 1.8. That is 360,000. But was it used for a whole year? No. It was only used for half of the year because it was purchased in July 2021. So there's 6 months remaining. July, August, September, October, November, and December. Those are 6 months. So we divide by 2. So the depreciation was 180,000 for the 6 months that it was in use. So what does this mean? That in 2021, KD wagon, the first vehicle, depreciated by 120,000. KF Toyota depreciated by 180,000. So the total depreciation for 2021 was 300,000 for the 2 vehicles. So we'll come here and say motor vehicle account depreciation is 300,000. 120 for KD wagon, 180 for KF Toyota, which is half of the year that it was used. Remember in 2020, the KD wagon also depreciated by 120,000, but that's a different thing. We are done with it. So we are computing for 2021. So this will give us a total of, so you might want to show these workings, or you might also, I'm just trying to give you so many options, or you might also want to show it here, so that instead of just writing, you can have KD whatever, and then you show 120,000, and then this other one 180,000. But since we have come with motor vehicle account, let's just go with the motor vehicle account and have it as 300,000. So you need to show the workings here, how you've arrived at the 300,000. That will be very important of you. So now that we are there, this will give us 420,000 like that. So we are closing the books, 420,000. Then we come here, we say on 31st December 2021, balance carried down is for 20,000. On 1st January 2022, we'll have a balance brought down of 420,000 as the depreciation. And then we proceed like that. So from this, you can see we have 2020 is running here, and then 2021 is also running here, which is okay. Just like we've had here 2020, 2020, and 2021. So you can as well take this and proceed from here. It is very much in order. So that is what the question wanted. The question wanted that we prepare 2020 and 2021 motor vehicle account, which we've done 2020 and 2021. And then provision for depreciation of motor vehicle account, we prepared for 2020 is here, the first part. For 2021 is here, the lower part. Thank you so much. Let's, do we have another question? Yeah, there is another question on that. I think our question is a bit, has been messed up a little bit. Let me see if we can get it right. Yeah, there we go. I think we've gotten it. So, explain how the following human resource functions may integrate with the accounting function. Recruitment. How can recruitment integrate with the accounting function? Recruitment involves use of money. Yeah, it involves money. And now that involves money, budget, there has to be a budget for it. That's how it integrates with finance, the accounting function. Yeah, I mean, money is used. So wherever money is used, we need to record the monies that have been used. We need to plan for that money And when we use that money, we need to capture the transactions as and when they happen. So that's how recruitment relates or integrates with the accounting function in terms of budgeting and in terms of recording the transactions that involve the usage of money. That's where they will relate. Workplace safety. Again, for budgeting, we must budget for workplace safety. This involves purchasing some or incurring some expenditure in terms of trying to equip the workplace with the safety precautions. And of course, we also have to, budgeting, usage of money. It involves usage of money. And then where we use money, we have to capture the transactions. Training, yes, training also involves budgeting and usage of money. Anywhere we have usage of money, we have to capture the records. That's the work of the accounts, capturing the transactions as and when they occur. So wherever we are talking about money, we need to capture that transaction, and that's where accounting now comes in. So it means that accounting and HR are very closely related, because HR spends, accounting captures the transactions as and when they happen. And before even capturing the transaction, it has to have planned for those transactions. Labor law compliance, of course, we have quite a lot here. The statutory deductions will come here. And of course, in terms of labor law, the employment laws, sometimes they will also involve expenditures. So we need to have budgets, and we need to have also any expenditure that will have been used in the process, just as I've said. Compensation planning, we must budget for compensation, how we are going to pay our staff, and when we pay them, we have to capture the records. And of course, we also have the statutory deduction coming here, which is done normally by the accountants. They are the ones who prepare these statutory deductions and remit them to the relevant authorities. So that's how it goes. All this, so long as we are talking about money, we have to budget, and we also have to capture the transactions as and when they occur. That is the end of it. So that's how you will earn your 20 cool marks from this question. Bye. Meet maybe in the next question. Thank you.